Yield curve strategies are among the most important active fixed income management techniques because changes in interest rates significantly influence bond portfolio performance. The yield curve plots yields against maturities for securities with similar credit quality, typically government bonds. Active managers attempt to generate excess returns by anticipating changes in yield curve level, slope, and shape that are not fully reflected in market prices. Successful implementation requires understanding how bond prices respond to interest rate movements and how portfolio duration, convexity, and maturity structure affect returns. Yield curve strategies seek to position portfolios advantageously before anticipated market changes, allowing managers to benefit from interest rate movements while controlling overall risk exposure. Fixed income portfolio returns can be decomposed into several components, each contributing differently to overall performance. These include coupon income, roll-down return, price changes resulting from yield movements, changes in credit spreads, and currency effects for international investments. Coupon income provides a relatively predictable source of return, while roll-down return arises when bonds move down a positively sloped yield curve and experience declining yields as they approach maturity. Price changes result from fluctuations in benchmark interest rates and are heavily influenced by duration and convexity. Understanding these return drivers allows managers to evaluate alternative portfolio structures and identify opportunities to enhance returns under different yield curve scenarios. When managers expect the yield curve to remain relatively stable, they may pursue strategies designed to maximize carry and roll-down returns. One common approach is extending portfolio duration by purchasing longer maturity securities that offer higher yields. Managers can also position portfolios in portions of the yield curve where roll-down effects are greatest, typically along steep segments. As time passes, these bonds migrate toward lower-yielding maturities, generating capital appreciation. Additional strategies include repo carry trades, which use short-term financing to purchase longer-term bonds, and leverage-enhancing techniques such as long futures positions or receive fixed interest rate swaps. These approaches seek to increase returns while assuming that yield curve conditions remain largely unchanged. Duration management is a central component of static yield curve strategies. A manager anticipating stable rates may increase duration to earn higher yields and enhance portfolio returns. However, extending duration also increases sensitivity to unexpected interest rate increases, creating greater downside risk if forecasts prove incorrect. Receive fixed interest rate swaps provide an efficient method of increasing duration without purchasing additional bonds, while futures contracts offer similar exposure with lower capital requirements. Managers must evaluate the trade-off between additional yield and increased interest rate risk. Effective duration positioning requires confidence that future yield movements will remain consistent with expectations and that market conditions will not change significantly during the investment horizon. Dynamic yield curve strategies are employed when managers expect changes in the level of interest rates. A manager forecasting a parallel decline in yields should increase portfolio duration because bond prices rise as yields fall. Conversely, expectations of rising rates justify reducing duration to limit capital losses. Portfolio duration can be adjusted through cash bond transactions, futures contracts, swaps, and other derivative instruments. The magnitude of duration changes depends on the manager's conviction and the expected size of the interest rate movement. Dynamic duration management allows portfolios to benefit from anticipated market developments while preserving flexibility to respond as new economic information emerges. Managers may also position portfolios based on expected changes in yield curve slope. A steepening yield curve occurs when long-term yields rise relative to short-term yields or when short-term yields decline more rapidly than long-term yields. In anticipation of steepening, managers may overweight short maturity bonds and underweight long maturity bonds. Conversely, expectations of a flattening yield curve encourage greater exposure to longer maturities and reduced exposure to shorter maturities. These trades can be structured to remain duration neutral if the manager wishes to isolate slope exposure rather than take a directional view on overall interest rates. Such strategies allow investors to capitalize on relative yield movements across different maturity segments. Changes in yield curve curvature provide another source of active return opportunities. Curvature strategies involve positioning between bullet and barbell portfolios. A bullet portfolio concentrates holdings around a specific maturity, while a barbell portfolio allocates assets to both short and long-term maturities. Managers expecting increased curvature, often described as a negative butterfly movement, may favor barbells over bullets. Conversely, Expectations of reduced curvature support bullet positioning. Because barbell portfolios generally possess higher convexity, they may perform better during periods of significant interest rate volatility. Managers often structure these trades to be duration neutral, enabling them to express views on curve shape independently from expectations regarding overall interest rate levels. The successful application of yield curve strategies requires a comprehensive understanding of fixed income risk exposures and market dynamics. Managers must evaluate duration, convexity, yield curve level, slope, and curvature simultaneously while considering implementation costs and portfolio constraints. Static strategies emphasize carry and roll-down opportunities when yield curves are expected to remain stable, whereas dynamic strategies seek to exploit anticipated changes in interest rate environments. Through careful portfolio positioning and disciplined risk management, active fixed income managers can generate excess returns by translating informed yield curve forecasts into targeted investment decisions. These strategies form a critical foundation of advanced bond portfolio management and performance enhancement.